Business loans and equity financing are popular ways for businesses to secure funds for growth and expansion. Let us compare both these financing options and understand better. The time frame for fund requirement is critical to decide the type of finance one should choose to pursue. Since equity financing is based on business valuation, it can take from a few months to more than a year to secure the funds and find interested investors. However, when your requirement is urgent, applying for a business loan is simpler and the process to get the funds is much faster. A business loan needs to be repaid with interest via EMIs. With equity financing, there is no repayment responsibility. However, the investors may sell off company assets or change the management if the projected performance is not met. Equity finance allows investors to gain ownership and control over business operations and profitability. Lenders of business loans will not have any say in the business operations. Business loans are sanctioned subject to meeting the eligibility criteria in terms of number of years of existence, stability of income, documentation, and more. Equity financing can be obtained by startups or established businesses based on the idea, viability of business model and projections. Fullerton India offers unsecured business loans of up to 50 lakh rupees at attractive interest rates. Click the link in the description to know more. Subscribe to our channel for more updates.